All eyes are on the Bank of Canada's next rate cut announcement that is going to be in March. There's been lots of news of the Bank of Canada potentially going as far as calling an emergency rate cut because of tariffs, but so far that's all amounted to nothing at the moment. Instead, we are now seeing opposite indicators, where the Bank of Canada is facing an uncertain rate cutting path. The latest data for inflation came out and it's risen to 1.9%. The Federal Reserve, so the Bank of Canada equivalent in the US, has just put a pause on the rate cutting path. And currently, the markets believe that there's a 63% chance of no rate cut in March. So if the US ends up imposing more tariffs on Canada in March, market expectations for a rate cut could change significantly. And this doesn't even account for all the employment data that's rather wonky right now, which ultimately means that the rate cutting path from the start of 2024 that we all expected is now in jeopardy. So what does this mean for the real estate market? How are people going to react to this news? And just how much of this is noise versus how much of it is actually signal, like stuff we should pay attention to? So be sure to keep watching as I sort of through all these factors in play for the next rate cut announcement date in March. Hi, my name is Zen, and you're enjoying my data-driven and number-crunching real estate updates. Be sure to like and subscribe. Uncertainty. This is the only thing that is certain right now. And I've said this in like the last few months before, and I'll say it again. We need to get used to it. It's unfortunate because when most people are buying and selling real estate, buyers and sellers actually want certainty. But I suspect we won't get much of that in 2025. And it'll be very volatile, so we have to get used to it. Even the Bank of Canada right now is confused on whether they should be pausing their rate cutting cycle or they should continue their rate cutting cycle. They don't even know. And even different banks and different economists from different banks and non-banks are all having a different opinion as well because things are so volatile and there are so many moving factors. And yes, it's a continuation downwards in terms of rate cutting for now, but not necessarily going up, as the probability of trending down for the rate cuts is still much higher than going up despite the inflation right now going up. And inflation should continue to go up in the next few months. Energy cost is increasing with tariffs. The silly HST break that we got in Canada is over, which would increase the CPI as well. And don't forget, in April, the carbon tax is going up by almost 20%, which is already going to increase the CPI itself. Self-inflicted, but to say the least, it is going to happen. And on top of all of that, we're not even sure if a federal election is going to be called after this Liberal leadership race. So a lot of silly Canadian politics are involved as well. Just ridiculous. Oh, did I also forget to mention there is a provincial election tomorrow as well? Just absolute chaos. That's all the bad news that is arguing for rates going up. But outside of tariffs potentially forcing the rate cuts down, you have these economic factors arguing for rates to be lower from the Bank of Canada. The monthly rent, CPI, is coming down. In fact, it's actually negative for the first time in over 2 years, meaning we're seeing rent deflation. Rent prices are coming down. Then you have the unemployment rate, which is going down, meaning we're increasing our jobs. But the labor force survey, which news articles report on, mostly uses anecdotal evidence from people making phone calls and taking a survey, like StatsCan. Come on, get it together. Which, personally, if you ask me, I don't trust that data. Because if you look at this data, it makes no sense that jobs are increasing because unemployment insurance claims are increasing. It's the same thing when you look at a decreasing payroll data as well. It makes no sense. So I would argue that the labor market, like jobs, is actually softening. And I do not think the Bank of Canada is blind to this. Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, put decades of experience to work for you. Then you got your mortgage interest rates rolling down from the peak because now rates are lower than they were last year. And just from sheer base effect, this in theory should drive down inflation as well because it was a huge component of it. You can also see that the cheapest mortgage rates right now are also trending down. And I expect us to see uninsured mortgages, which are mortgages with a down payment of 20% or greater, to go below 4%. It's like hovering a little bit over 4 right now. The insured mortgages, which is less than 20% down, is already below 4% right now, which means your monthly mortgage carry cost on a typical home continues to trend down, although not in a straight line because rates are fluctuating up and down, which are all great signs for people who have a mortgage that are renewing. However, the damage in the last few years has been done, and mortgage delinquencies are increasing from their lows during the pandemic. Granted, they are still very low and nowhere near the level that we saw in the great financial crisis yet. But even if we get there, that's effectively only 4 mortgages delinquent for every 1,000. So I don't think it's that bad. So at the moment, I'm watching it, but I'm not that concerned. But of those mortgages that are delinquent, I suspect a lot of them are probably like second mortgages, right? Or people that are non-prime loans, right? Like not the big banks. Now, to top all this off, this was also like a low-key press release in Bank of Canada's last announcement where they decided to end quantitative tightening, or in regular people terminology, they're stopping the removal of money from the economy, which coincidentally aligns with the money supply increasing right now. So you can see that M2 growth, which is the money supply, is increasing, which means our currency is inflating, or our purchasing power is decreasing again. So those are all the macroeconomic factors I'm watching for. And as you can see, there are arguments on both sides for rate coming down and the side for rate going up. And if anyone tells you they know what's going to happen next, I will say they're lying to you, or they're very, very ignorant of what's actually happening. This is why it's so important for you to understand your own personal situation before buying or selling any real estate. Because despite all this information and knowledge and charts I just dropped on you, everyone personally thinks by reading all these news and watching all these YouTube videos, they think they understand all these macroeconomic factors that helps them decide on whether they should time the market properly. And I actually find it actually paralyzes most people because it's information overload. My solution, Occam's razor, which basically just means that the simplest explanation is the best explanation, and that is inventory. Currently, there's over 20,000 unsold properties again in the Greater Toronto area, and it's a lot. And with this much uncertainty in the market, I'm pretty confident a lot of buyers have put their buying process on pause, meaning this amount of unsold inventory is going to continue to grow into the spring market. Now, where a lot of this unsold inventory is actually in the condo space, which makes up 50% of the listings in the Greater Toronto area. That is abnormally high from what we normally see. There is usually a lot more freehold homes. And this is why we see a 70% increase in unsold properties. And this is exactly what I talk about here in this video. But the caveat is that the low-rise freehold homes are performing normally, where condos are not. So make sure you watch this video over here to understand that the inventory is what dictates where prices are going to go in the next 2-3 months. Not all this macroeconomic mumbo jumbo. I'll see you in the next episode. And remember, your move, your future. See ya.